Welcome to The Explainer. Let's jump right into a genuinely historic showdown happening right now at the Federal Reserve, and more importantly, what it literally means for your wallet. For the first time ever, a newly appointed Fed chair is openly pushing for a total regime change at the very institution that controls the cost of money in America. If this goes through, it completely resets the board, changing everything from how we calculate inflation to the exact interest rates you pay on your mortgages and earn on your savings.
So, what happens when the Federal Reserve suddenly has two chairs? Right now, we're staring down a wildly awkward scenario that we literally haven't seen in 75 years. You've got Jerome Powell refusing to step down, while Kevin Warsh is appointed as the new chair. Now, this is way more than just some bureaucratic drama in Washington. It means the people with their hands on the levers of our entire monetary system have radically different philosophies about what to do next. Here is our roadmap for today. We'll start with this unprecedented Fed transition, then break down Warsh's four-part policy reset. After that, we'll compare Powell and Warsh head-to-head, look at the real-world impact on housing affordability, map out the market winners and losers, and finally go over how you can protect your cash holdings. Okay, Section 1, the unprecedented Fed transition. Let's get some context on how this historic standoff actually built up. Typically, a Federal Reserve chair serves a 4-year term. And when it's up, they just politely pass the baton. The last time a transition was delayed like this was way back in 1948. But honestly, that was just because President Truman specifically asked the chair to stick around. Today, well, nobody is asking Jerome Powell to stay. He's flat out refusing to leave, pointing to what he calls unprecedented legal attacks. So we've got a situation with two leaders in the same building, pushing entirely different economic plans. Moving to Section 2, the four-part policy reset. This is absolutely crucial because we aren't talking about tiny tweaks to interest rates here. Warsh recently laid out a highly specific four-part reset during a Senate hearing. He wants to aggressively shrink the Fed's balance sheet, give no more warnings to the market, fundamentally change how inflation is measured, and shift the Fed to a model of earned independence. His whole argument is that this will turbocharge the real economy. But, and this is a big but, critics are warning this exact cocktail of policies could crash the stock market and spike interest rates simultaneously. Let's look at why. Step 1 is massive. The Fed is currently sitting on $6.7 trillion in bonds and mortgage-backed securities. They scooped these up during the 2008 financial crisis and COVID to basically flood the system with money. Warsh wants to aggressively chop this down by a couple $1 trillion, arguing a smaller balance sheet means less distortion in the market. But yanking that much cash out of the financial system, yeah, that's exactly what's making investors sweat right now. Then there's step 2, killing the dot plot. For 14 years, pretty much every hedge fund manager and mortgage lender has stared at this chart to predict where the Fed will take rates next. Walsh wants to scrap it completely. No more forward warnings. He also wants to slash their annual meetings from 8 down to just 4. He thinks a Fed that talks less is a healthier Fed. The market, though, they are terrified this lack of guidance will trigger abrupt, violent sell-offs because they won't be able to gradually adjust to new data. Let's hit Section 3, Powell versus Warsh compared. To really grasp this new regime, we need to put it right next to Jerome Powell's playbook. The ideological gap between these two is staggering. Under Powell, the Fed's independence was sacred, period, and inflation was tracked using the core PCE gauge, which strips out food and energy. Warsh, on the other hand, wants earned independence based on hitting targets, and he wants to switch to a trimmed averages inflation gauge. That basically drops the most extreme price changes from the math entirely. So markets are legitimately questioning, is this a clever way to just make inflation look lower on paper? Because if it is, that lets him cut rates, but real-world prices could still be spiraling out of control for the rest of us. Which brings us to Section 4, impact on housing affordability. Let's take all this high-level macroeconomics and bring it right to your front door. Remember that $6.7 trillion balance sheet? When Warsh shrinks it by actively selling off mortgage-backed securities, he is literally removing the very assets that make your home loans possible. The immediate consequence here is that housing affordability basically freezes. The market is losing its absolute biggest buyer of mortgage debt. Because of that massive shift, and because bond investors are demanding higher returns for the inflation risks under Warsh's plan, mortgage rates are knocking on 7% again. This is a brutal headwind for first-time buyers. Look, even if the Fed cuts short-term rates eventually, the borrowing cost for a house only drops if long-term investors truly believe inflation is dead. And looking at Warsh's policies, they clearly don't believe that yet.
Next up, Section 5, Market Winners and Losers. This giant pivot in the cost of money is drawing some very stark lines in the sand. The market is rapidly pricing in a new reality. Higher interest rates for a longer period absolutely crush speculative growth stocks, tech plays, and anyone relying on borrowed money. But flip the coin, and this environment is a gold mine for savers and banks. Banks win because they can charge a premium for long-term loans. Plus, the US dollar actually strengthens in this scenario, meaning your money goes a lot further if you're buying overseas. Now, let's talk about the absolute danger zone. If you are carrying variable debt right now, like the thousands of dollars the average person holds on a credit card, this is a wake-up call. The lack of quick rate cuts means that those 20+% interest rates are not budging anytime soon. The era of free, cheap money is definitively over. Borrowing is going to stay painful. On the completely opposite side of the spectrum, look at the incredible setup for savers. If you want safe, predictable returns without the roller coaster of the stock market, government treasuries are paying out big time. We're seeing 30-year treasury yield sitting above 5%. That's the highest we've had in almost 2 decades. While stocks might beat that over a 30-year timeline, in the short term, savers are finally actually getting paid to hold their money safely. Let's wrap up with Section 6, protecting your cash holdings. Regardless of who wins this turf war at the Fed, here is exactly how you should think about your own money right now. Based on the economic analysis of this whole transition, the source material suggests playing a highly defensive but active game. The recommendation is keeping roughly 20% of your portfolio as dry powder, basically cash sitting on the sidelines. Thanks to where rates are at, that cash can safely earn around 3.5% to 4% right now. The other 80%? Keep that in diversified investments, staying steady while the dust settles. So, here are your real-world takeaways. First, do not hold your breath for cheap money to suddenly return. It's highly unlikely over the next 12 months. Second, keep dollar cost averaging into your investments systematically. Third, at all costs, avoid over-leveraging yourself on variable debt. Just let that cash work for you defensively. The people who navigate this successfully will be the ones who stay diversified, keep that 20% dry powder ready, and absolutely refuse to panic sell when things get volatile. As we sit back and watch this unprecedented clash unfold at the Federal Reserve, we're really waiting to see if this regime change is the spark that turbocharges the economy or the misstep that crashes it. But the real question we have to ask ourselves is this: can public trust be restored through this radical 4-part reset, or are we permanently adapting our lives, our businesses, and our portfolios to a new, unforgiving era of expensive money? Take a hard look at your own wallet because the rules of the game have officially changed.